In the shadowed expanse of the Persian Gulf, where ancient trade routes once carried spices and silk across the waves, a new chapter of human conflict unfolded on February 28, 2026. As the first light of dawn pierced the horizon, the skies over Tehran erupted in a symphony of precision and destruction. The United States and Israel, bound by strategic imperatives and a shared resolve to confront what they perceived as an existential threat, initiated a series of coordinated military strikes against Iran. This operation, shrouded in the rhetoric of preemptive defense, targeted nuclear facilities, military command centers, and symbols of the regime's authority. Explosions reverberated through the Iranian capital, shattering the morning calm and claiming lives in a tragic escalation that blurred the lines between military precision and civilian catastrophe. Reports emerged of strikes near a girls' school in southern Iran, where the toll included innocent children, amplifying the human cost of geopolitical maneuvering. Yet Iran's response was not one of retreat, but of fierce retaliation, transforming the conflict from a targeted assault into a sprawling regional inferno. The Islamic Revolutionary Guard Corps, the vanguard of Iran's military might, unleashed a barrage of ballistic missiles and drones that arced across the Gulf, striking at the heart of American influence in the region. Bahrain's naval bases, home to the US Fifth Fleet, were engulfed in fire and chaos as intercepts lit up the night sky. In Qatar, the sprawling Udeid airbase, a linchpin of US operations in the Middle East, activated its defenses, downing incoming threats amid a cacophony of alarms. Kuwait felt the shockwaves directly, with drone strikes impacting its international airport and military installations, sending plumes of smoke into the arid air. The United Arab Emirates, a beacon of modern opulence, was not spared. Abu Dhabi and Dubai witnessed interceptions that rained debris upon residential areas, claiming at least one civilian life and forcing evacuations from iconic landmarks like the Burj Khalifa and the Palm Jumeirah. Even Jordan and Saudi Arabia, on the periphery of the immediate fray, scrambled air defenses as the assault's reach extended, closing vast swathes of airspace and grounding commercial flights. This cascade of violence marked a perilous expansion of the battlefield. For decades, the Persian Gulf states had navigated a delicate balance, hosting American forces while pursuing economic ambitions that turned deserts into metropolises of glass and steel. Now, Iran's strikes pierced that veneer, targeting not just military outposts, but the very infrastructure that symbolized the Gulf's prosperity. Dubai's international airport, the world's busiest hub for global transit, suspended operations indefinitely, stranding thousands and halting the flow of goods through its free zones. Kuwait's ports, vital arteries for oil exports, faced disruptions that rippled through supply chains. These attacks were no mere reprisals. They were a calculated assertion of Iran's doctrine of asymmetric warfare, designed to impose costs on those who sheltered its adversaries. As the dust settled and the world watched in stunned silence, one question echoed through diplomatic chambers, newsrooms, and households alike. Is this the ignition of World War III? The spectre of a global conflagration has haunted humanity since the ashes of the last great wars. And here, in the volatile crucible of the Middle East, the ingredients for such a disaster seemed perilously aligned. Historical precedents loom large. The assassination in Sarajevo that unleashed the carnage of 1914, or the Japanese strike on Pearl Harbor that drew the United States into the abyss of 1941. In each case, regional grievances entangled great powers through webs of alliances, mutual suspicions, and the inexorable logic of escalation. Consider the alliances at play today. On one flank stands the formidable coalition of the United States and Israel, fortified by the Abraham Accords that have woven Sunni Arab states like the United Arab Emirates and Saudi Arabia into a tacit anti-Iran front. These nations share a common dread of Iran's regional ambitions, its support for proxy forces from Hezbollah in Lebanon to the Houthis in Yemen, and its pursuit of nuclear capabilities. The strikes on Gulf soil have activated these bonds. Bahrain and Qatar, as hosts to US bases, now find themselves unwilling participants, their skies a theater of interception and retaliation. Saudi Arabia, though not directly hit in the initial volley, has heightened alerts. Its oil fields, still bearing scars from past Houthi attacks, now under renewed threat. Opposing this axis is Iran, resilient and defiant, bolstered by strategic partnerships with Russia and China. Russia, mired in its own protracted conflict in Ukraine, has supplied Iran with sophisticated weaponry, including air defense systems that complicate Western airstrikes. The two nations share a mutual interest in challenging US hegemony, with Moscow viewing the Middle East as a secondary front to divert American resources. China, meanwhile, depends on Iranian oil for a significant portion of its energy needs and has invested heavily in the region's infrastructure through its Belt and Road Initiative. Beijing's response could manifest in economic pressures or naval deployments in the Indian Ocean, safeguarding its interests without direct combat. Add to this North Korea's shadowy role in missile technology transfers, and the potential for a broader coalition emerges, one that could draw in peripheral actors and escalate tensions across multiple theaters. Yet, the path to a Third World War is not inevitable. It hinges on the fragile threads of restraint and diplomacy. Unlike the rigid pacts of 1914, modern alliances allow for flexibility. NATO's collective defense clause has not been triggered, as the attacks remain distant from European soil. European powers, scarred by energy crises following Russia's invasion of Ukraine, have called for de-escalation through the United Nations, emphasizing humanitarian corridors and ceasefires. Back-channel negotiations, a staple of Middle Eastern crises, persist. Recent talks in Geneva had shown glimmers of progress on nuclear issues before this eruption. The economic interdependence of the modern world acts as a brake. Global supply chains, financial markets, and energy flows bind adversaries in ways that deter total war. Still, the risks are profound. Iran's arsenal of asymmetric tools, cyber intrusions into critical infrastructure, sabotage of shipping lanes, or coordinated proxy assaults, could provoke responses that spiral beyond control. A successful cyber attack on US power grids or financial systems might invoke broader alliances. If Russia deploys forces in support of Iran, or if China blockades key trade routes in retaliation, the conflict could metastasize. Public opinion, amplified by instant global communication, adds volatility. In the United States, polls reflect a war-weary populace, while in Iran, nationalist fervor surges. Historians draw parallels to the Cuban Missile Crisis, where miscalculation nearly unleashed nuclear Armageddon, reminding us that human error, not grand strategy, often tips the scales. Assuming the conflict endures, its economic reverberations will be seismic, beginning with the energy sector. The Persian Gulf is the beating heart of global oil production, accounting for nearly a third of the world's supply. The Strait of Hormuz, a narrow choke point no wider than 21 miles at its tightest, channels 20 to 21 million barrels of crude daily, equivalent to 1/5 of global consumption, alongside vast quantities of liquefied natural gas from Qatar. Even partial disruptions, as seen in the current chaos, have paralyzed tanker traffic. Vessels now linger at anchor or reroute through longer, costlier paths, while insurance premiums for Gulf voyages have quadrupled, deterring all but the most essential shipments. The immediate market reaction was visceral. Brent crude futures surged over 25% in the opening hours, shattering the $120 per barrel threshold and climbing toward levels not seen since the early 2020 energy shocks. Analysts project that sustained hostilities could propel prices to $150 or even $200 per barrel, depending on the duration and intensity of disruptions. Saudi Arabia's East-West pipeline offers a partial bypass, capable of redirecting 5 to 6 million barrels per day through the Red Sea. But this is a mere fraction of the strait's volume. The United Arab Emirates and Kuwait, lacking robust alternatives, face acute vulnerabilities, compelling reliance on global strategic reserves. The United States Strategic Petroleum Reserve, holding around 700 million barrels, provides a temporary cushion, perhaps 60 to 90 days at full utilization, but replenishing it amid conflict would prove arduous and expensive. Inflationary pressures cascade from these spikes. Higher crude costs permeate every facet of the economy. Transportation fuels like gasoline and diesel rise sharply, adding layers to consumer prices. In the United States, average pump prices could escalate to $5.50 to $7 per gallon, siphoning disposable income from households and curbing spending on goods and services that fuel 70% of GDP. Europe, still healing from the scars of Russian gas cutoffs, confronts renewed LNG shortages. Spot prices have already leaped 30%, threatening industrial output in energy-intensive sectors like chemicals and manufacturing. Factories in Germany and Italy, hubs of European industry, may curtail production or shutter temporarily, echoing the shutdowns of 2022. Asia endures the most severe blow. China, the world's largest oil importer, sources a substantial share from the Gulf. Disruptions compel a frantic pivot to Russian, African, and Latin American supplies, but at premium costs and with logistical hurdles. India's economy, reliant on imports for 85% of its crude, grapples with a widening current account deficit, rupee depreciation, and inflationary surges that undermine recent stability gains. Japan and South Korea, dependent on seaborne LNG for electricity and heating, face potential blackouts and forced rationing in heavy industry, shaving points off GDP forecasts. Longer term, the energy landscape undergoes profound shifts. A persistent war premium elevates baseline prices, incentivizing non-Gulf producers, the United States with its shale basins, Canada with oil sands, Brazil with offshore fields, to ramp up output. Yet this response lags. Drilling rigs require months to mobilize, and environmental regulations in many jurisdictions slow the pace. OPEC+, the cartel that once stabilized markets, fractures under strain. Members like Russia benefit from high prices, but risk demand destruction as consumers accelerate transitions to renewables. Electric vehicle adoption surges in response to fuel costs, while governments subsidize solar and wind projects to insulate against future shocks. Paradoxically, the crisis enriches some, American energy giants see windfall profits, while impoverishing others, widening global inequalities. The inflationary contagion extends beyond energy. Supply chains, already fragile from pandemics and trade wars, buckle under higher freight rates and delays. Maritime shipping imposes war risk surcharges, while airlines ground flights over contested airspace, inflating costs for perishables and electronics. Food prices climb as fertilizer inputs, tied to natural gas, escalate, affecting harvests worldwide. Central banks face a stark dilemma: hike interest rates to tame inflation, risking recession, or maintain accommodative policies that entrench price spirals. In emerging markets, where food and fuel consume larger budget shares, social unrest looms, potentially destabilizing governments from South Asia to Latin America. Real estate, often viewed as the most stable of asset classes, reveals its vulnerability when geopolitics collides with geography. In the Persian Gulf, the epicenter of the crisis, property markets that had become synonymous with audacious ambition now confront a brutal reckoning. Dubai, the glittering jewel of the United Arab Emirates, had spent 2 decades redefining urban possibility. Towering skyscrapers, man-made islands shaped like palms in the world, artificial ski slopes in the desert, luxury retail districts that rivaled Paris and Milan. All of it rested on a delicate foundation: investor confidence, expatriate inflows, tourism revenue, and the perception of political stability. On February 28, 2026, that foundation cracked. Explosions near the Palm Jumeirah sent shockwaves through luxury villas and penthouses. Smoke rose from a 5-star hotel whose rooftop infinity pools had once featured in countless social media posts. The Burj Khalifa, the tallest building on Earth and a global symbol of ambition, was evacuated as air raid sirens wailed and interceptor missiles streaked overhead. Dubai International Airport, the planet's busiest for international passengers, shut down completely. Cargo terminals that handled everything from electronics to perishables ground to a halt. Within hours, real estate portals reported a flood of listings from panicked sellers. Off-plan purchases froze as developers suspended marketing events. The mathematics of the downturn are stark. Dubai's residential market had been riding a multi-year boom fueled by crypto wealth, Russian capital flight, Indian HNWI migration, and post-pandemic lifestyle seekers. Average sale prices in prime districts had climbed 35 to 45% since 2022. Now, analysts project an initial correction of 20 to 35% in the most exposed waterfront and downtown segments, a drop that would erase years of gains in weeks. Commercial leasing, already pressured by hybrid work trends, faces vacancy rates that could double as multinational corporations accelerate relocation planning. Hospitality properties, hotels, service departments, branded residences, see occupancy plunge toward single digits as airlines cancel routes and corporate travel bans take effect. Abu Dhabi, more conservative and sovereign wealth fund driven, is not immune. The Emirates' real estate market had been carefully curated around long-term institutional capital rather than speculative retail buyers. Yet the diversion of sovereign funds toward emergency defense spending, reconstruction, and economic stabilization packages reduces liquidity for property acquisitions. Yas Island developments, Saadiyat cultural projects, and Al Reem Island high-rises, all dependent on steady government-linked investment, face delays and repricing. Kuwait and Bahrain present a different but equally painful picture. In Kuwait, Strikes near military installations and the international airport have damaged confidence in the commercial real estate corridor along the Gulf Road. High-end residential compounds that cater to expat oil executives see early lease terminations. Bahrain, smaller and more exposed due to the direct hit on the US Fifth Fleet base, confronts a sharper exodus of foreign residents. Manama's financial harbor district, once marketed as the next DIFC, now contends with images of missile interceptions looping endlessly on global news feeds. Beyond the Gulf, the contagion spreads more slowly, but no less surely. Global real estate investors treat geographic risk as a portfolio variable. When one of the world's most important energy and financial hubs becomes a literal war zone, capital reallocates. Prime residential markets in London, New York, Paris, Singapore, and Zurich record accelerated inflows from Gulf high-net-worth individuals and family offices seeking safe custody for wealth. Yet even these havens are not entirely insulated. Rising energy costs act as an invisible tax on households everywhere. In the United States, where mortgage affordability was already stretched by interest rate normalization, gasoline and heating bills that consume an additional 3 to 5% of disposable income push marginal buyers out of the market. New home sales slow. Existing home listings rise as families downsize or delay moves. Commercial real estate, office towers, retail centers, industrial warehouses faces a double blow. Higher operating expenses from utilities and insurance, combined with softening tenant demand as businesses retrench. Europe confronts a similar dynamic, overlaid on its own structural challenges. Germany's industrial heartland, already reeling from the 2022 gas shock, sees factory owners defer expansion plans and delay property purchases. Southern European tourism markets, Spain, Portugal, Greece, suffer as air travel costs soar and consumer confidence wanes. In the United Kingdom, London prime property had benefited from a post-Brexit stabilisation. Now, Gulf capital inflows provide temporary support, but domestic buyers face squeezed budgets and rising service charges in energy-intensive buildings. Emerging markets feel the pain most acutely. Turkey, Egypt, Pakistan, and several Southeast Asian nations had relied heavily on Gulf investment in residential and hospitality projects. That capital now dries up or reverses. Local currencies depreciate under twin pressures of energy import inflation and risk-off sentiment, elevating local borrowing costs and depressing transaction volumes. In India, the luxury residential segment in Mumbai, Delhi NCR, and Bengaluru, which had attracted substantial NRI money from the Gulf, sees cancellations and price renegotiations. Central banks around the world are forced into an excruciating balancing act. Headline inflation, already elevated in many economies, surges further as energy and food costs pass through the supply chain. Yet simultaneous economic contraction, falling consumer spending, deferred corporate investment, disrupted trade, creates classic stagflation conditions. Raising interest rates aggressively to anchor expectations risks tipping already fragile economies into outright recession and accelerating property price declines. Holding rates steady or cutting prematurely allows inflation psychology to embed, raising the eventual cost of control. Financial markets reflect this tension in real time. Equity indices in energy-importing nations correct sharply. Sectors most exposed to consumer discretionary spending and high operating leverage suffer the deepest drawdowns. Conversely, shares of non-Gulf oil producers, defense contractors, and commodity traders post outsized gains. Bond yields in safe haven currencies initially compress as investors seek shelter, then steepen as inflation fears dominate. The US dollar strengthens markedly on flight to quality flows, creating headwinds for emerging market debtors and commodity exporters alike. Gold and other traditional stores of value rally as uncertainty premiums expand. Bitcoin and major cryptocurrencies experience violent two-way volatility. Initial sell-offs driven by risk aversion, followed by sporadic safe haven buying, as some investors treat digital assets as an uncorrelated hedge. Yet the broader message from capital markets is caution. Liquidity is king, and duration risk is punished. If the conflict proves short-lived, contained through intense diplomacy, limited to tit-for-tat strikes, or resolved via a face-saving ceasefire, economic scarring will still be deep, but ultimately reversible. Energy prices would retreat from peak levels within months. Strategic reserves would begin refilling, and Gulf reconstruction spending could spark a localized boom in cement, steel, and engineering services. Property markets in Dubai and Abu Dhabi would likely stabilize within 12 to 18 months, supported by returning confidence and fresh capital inflows chasing post-crisis discounts. A protracted war, however, rewrites the script. Sustained closure or severe harassment of the Strait of Hormuz keeps the war risk premium baked into energy prices for years. Global inflation settles at structurally higher levels, forcing monetary policy regimes to tolerate less growth for the same degree of price stability. Supply chain reconfiguration accelerates. Nearshoring, friendshoring, dual sourcing become imperatives rather than options. The energy transition, paradoxically, both accelerates and stumbles. Renewables gain on cost competitiveness grounds, yet the capital required for grid upgrades, battery storage, and electrolyzers must compete with defense budgets and reconstruction needs. In the Gulf itself, reconstruction becomes a generational project. Skyscrapers, repaired or rebuilt, carry higher insurance loadings and fortified design standards. Tourism reinvents itself around fortified luxury rather than carefree opulence. Sovereign wealth funds, depleted by emergency drawdowns, adopt more conservative allocation strategies, reducing risk appetite across global asset classes. Ultimately, February 28, 2026, will be remembered not merely as a day of missiles and sirens, but as the moment when one of the world's most critical arteries was exposed as perilously fragile. The Strait of Hormuz is only 21 miles wide at its narrowest point. The skyscrapers of Dubai rise half a mile into the sky, yet both rest on the same precarious assumption that rational self-interest among great powers will forever outweigh the logic of escalation. When that assumption fails, even briefly, the consequences cascade through fuel pumps and grocery aisles, through mortgage applications and eviction notices, through boardrooms and war rooms, through the quiet calculus of central bankers and the louder anguish of families watching news feeds in real time. Whether this marks the true beginning of a Third World War remains an open question, one that historians may debate for decades. What is already clear is that the cost of answering it wrong will be measured not only in lives, but in the slow, grinding erosion of the prosperity the modern world had come to take for granted. The sirens have quieted for now. The smoke still lingers, and the world waits to see whether the next dawn brings de-escalation or something far darker.